Well, hello, everyone. Thank you for joining us for another episode of Two Economists and a Lender, where we take a deep dive into the most important agricultural issues facing us today. I'm your host, Carly Jacobson, and once more we have David Widmar and Brent Gloy here from Agricultural Economic Insights, taking an analytical look at the different farmland rental agreement options and consider the advantages or disadvantages depending on your situation of each. So we're also lucky to have Shannon Heinert here today. She's a financial officer out of the Southeast South Dakota region, joining as our lender expert. So Shannon has 8 years of ag lending experience. We're looking forward to another great conversation here today. We do have a poll again this month, so stay close to your computers to share with us your thoughts. And let's get right to it. Brent, you want to take it away?
Sure. Thanks, Carly. Welcome back, everyone. It's great to see everybody again this week. Well, we can't actually see you, but anyway, I'll pretend we can. We'll jump right in with that poll and start off with a simple question. What's the most common crop share agreement in your area?
So Brent, full disclosure, this question was my idea. I, of course, grew up in eastern Kansas and now in Indiana most of my time. And I always find it interesting because you always hear, well, a typical share agreement is X, and they list out the terms. But as you move around the country, my perspective has been there's a lot of differences as you move around, and different geographies have different. So I'm excited to see this.
Bob Taylor, one of my favorite professors at Purdue, farm management, always said the 13th commandment was that on the tablets was that God demanded it was a 50-50 crop share rental agreement. So anyway, as you might guess, there's a lot of diversity, and the point of that question, I think, was to try and bring that up, that there's a lot of diversity in crop share agreements and rental agreements in general, and for good reason. And that's one of the things we want to talk about today, is how to pick an agreement that fits and works best with for each party. Now, one of the things that gets talked about the most, though, is the cash rental agreement and the cash rental rate in particular. And we thought this chart was kind of interesting. This just shows the change in farmland cash rental rate in annual percentage terms across the country. And as you can see, kind of the upper Great Plains, northern Great Plains has seen the highest annual increases in cash rental rates across the country. But in places like Iowa, just short of 3% a year, Nebraska getting pretty close to 4%, South Dakota 5.2%. So we've seen some diversity there. And I think when you look at those cash rental rates, most of that increase occurred in the first half of the last 10 years. And since the last 5 years, the rental rates have actually been pretty flat. So I just wanted to provide you with that information to start with. And then let's start talking a little bit about farmland rental agreements. And I think the most important thing is that what we're trying to do is find a fair agreement for everybody, but understand there's lots of different trade-offs that have to be made as we're thinking about rental agreements. Part of it is risk versus return, and everybody has a different kind of comfort level with that. Some landowners might prefer very little risk, others willing to take more risk, and we want to structure a rental agreement to capture that. Another big thing is how engaged do the various parties want to be, and how much record keeping and other things have to be involved with different types of rental agreements, and do both parties feel like they can benefit from having some level of engagement in the rental agreement. And then a big question is always, what does the future have in store? And that comes into play a lot when we start talking about the length of the rental agreement. And so we'll talk about all those things.
Another point that highlights the importance of farmland agreements and making sure that we're doing a good job in managing these and putting these together is that rent accounts for a large share of total revenue or total expenses, however you want to look at that. It might account for 30% or more of all of our operating expenses. It depends on how much of your farm you own versus rent, and it depends on your cost structure. But this is something that, as a manager, you should be monitoring and keeping in the back of your mind. But regardless, rent is a huge chunk of all of our operating expenses. And the third point that underscores the importance of farmland rental agreements is that a large share of farmland in the farm economy is on a rental basis. And so I broke out some of the data for the states relevant to the listeners today, but Kansas is at 51%, Iowa's at 53%, Nebraska at 44%. So nearly half of the acres in those states that are in row crops, right, farmland, are under a rental agreement. So it's complicated, as Brent said. It's a large expense, or a large part of our budgets, and it's a large part of our operating base, or our acreage base. And so we need to spend a lot of time thinking about this. So the next thing we wanted to share, which is interesting, the USDA does a survey. It's a survey, it's kind of the Census of Ag, but specifically for farmland and the farmland owners and all the elements that are involved in that. And so which type of arrangement is most common? Well, they break it out into 4 categories. The cash rent is the most common. 70%, or 7 out of every 10 acres, are under a cash rental agreement. This is a little bit higher than I thought, but it is a very steady and a huge majority of the rental agreements we see. The second most common one comes in at 21%. It's share agreements, followed by the flex at 7%. And finally, the USDA has a category of free agreements. And so this might be some arrangement you have with a family member, or maybe you have it with a neighbor where you're helping in some other way, but there's not really a trade of monetary. You're not paying for it in bushels or acres. Maybe you're helping them out in other ways, or just getting a really good deal. I find the flex agreement really interesting here. It gets a lot of attention, right? But we don't see it actually in a lot of acres being used. How does this vary across the association states? The USDA breaks this out again. Cash rent is the most popular in most states. It gets as high as 80% in South Dakota, almost 80% in Iowa. Again, that's above the 70% at the national level. Look at the share agreements. Share agreements are about a quarter of the acres in Nebraska and about half of the acres in Kansas. In fact, there's more share agreements in Kansas than there are cash rental agreements. And finally, the flex, a little more common in Nebraska and Iowa than the national average, but still way below what we see those other agreements. So there is variability. There's variability across states and regions. And the reason why it's important that we wanted to share this is because each one has features and benefits that are attractive. And so we want to outline those. And so as you're thinking about rental agreements and how you structure those, rather than saying, what's the best agreement, asking somebody, what's the best agreement, what price should I pay? We encourage you to sort of think about it for yourself and create a plan that works best for you in your situation.
Yeah, and the fixed cash rent, as David showed in those last slides, is the predominant lease type, and there's a lot of reasons for that. One, it can be easier to negotiate. Usually, most of the negotiation time is spent on one aspect of that lease, and that's the rate. It also helps to plan and budget on the producer side as well as the landowner side. The landowner usually gets, or the operator usually gets, a lot of autonomy, but it also creates a pretty significant cash flow and creates some significant downside risk, because what is happening is a lot of the risk of the crop production enterprise is taken by the producer as opposed to the landowner. So it removes risk for the landowner, doesn't require nearly as much management, but oftentimes not going to be the highest return. If you think about it, less risk is usually related to less return. Now, the other thing I always remind people is that we spend all our time thinking about what the rate is, and a lot of times there's a lot of other things that can be negotiated in these rental agreements. Term, amount of control, when the rent's due, all of that kind of stuff can open up to provide some flexibility, so you can maybe get off that negotiating term of just the top line number.
That's really great. I think for landowners, as you mentioned, just to reiterate this, one of the big advantages to landowners is it's a predictable cash flow. It's very if there's a multiple year agreement, or even if they're on the cash rate, if they have to change producers down the road, they know what that's going to be with some degree of predictability. The second is this flex rent agreement. And the flex rent agreement, just for a little bit of background, is there's some sort of a base, usually a base cash payment. And then if some threshold is reached in terms of productivity or revenue, then there's a bonus paid. And so the idea with this is, let's take some of the elements of the cash, the fixed cash agreement, that predictability over time, but then let's also create a mechanism where the landowners can be rewarded with a higher return when things do well. And so how do we get a mechanism that rewards for good commodity prices and or good production? And for the producers, one of the advantages is that it removes some of the downside risk. Usually you pull that base rate a little bit below what you'd pay for a traditional cash rent. So you're trading off that base rate, you pull it down a little bit, and then you include that bonus to the upside. It does require some additional planning and budgeting, especially if there's going to be a bonus paid. And then, of course, you have to manage that bonus element. How do you actually go about managing that with respect of calculating whether or not that flex has been exercised?
David, I think one of the pitfalls to the flex leases is that people overcomplicate them, and you can flex the rent on a million different factors, and the more complicated it is, the harder it is to explain and communicate and negotiate, and it just becomes really challenging. So if you're thinking about a flex cash rent, we encourage you to start by thinking simple and flex on something that's easily measured and predictable to you. And one example I'll give is, if you just flex, say, on price, the price could go up. If you have a terrible crop, you could end up having to pay a lot of rent. And same thing with yield. So, we want to really make sure we understand what the return profile looks like as we do that.
At a high level, right? This flex agreement is a partnership between both parties, and they both want to work together, right? When times are lean, the landowner wants to make sure the producer isn't paying too much, right? And then when times are good, the producer wants to make sure the landowner gets compensated fairly. And so, to Brent's point, there's nothing that gets more frustrating than whenever you enter this agreement trying to help both parties, and one party gets confused or feels like they should have received that bonus whenever something else came to play. So that it's really hard to get right. Finally, the share agreement, which is traditionally a portion of the expenses are shared, but also a portion of the bushels raised is shared. And these become favorable to the producer because now cash rent starts to represent a variable expense, right? So if the yields get hit, that the amount that's paid out, the bushels traded off for that rent is lower. It also has a huge advantage of being less cash flow intensive. We don't have to pay some of that check. We have to write the check for rent in the spring, but also some of our expenses are offset by the landowner. And that could have some balance sheet implications. We're thinking about our working capital reserves that we need when you have less cash flow going out and less risk as to whether it's a risk management tool to help weather some of the variability in yields. One of the barriers here to this is there's a significant management of the partnership with the landowner, right? You might have to work with them about helping them understand what some of their expenses might be, making decisions about fertility or crop protection or fungicide applications. So it has it's going to require a lot of communication between both parties. For the landowner, it has a high ROI possibility, and that's really attractive. Again, it's going to have some cash flow outflows potentially, and you're going to need to have a trusted farm partner. Make sure you have somebody, because your returns are linked to how the crop does. And so you want to make sure that you have a farm partner that you can trust. And like we mentioned earlier, the local norms heavily influence this sharing arrangement, but there's opportunity here to really understand what both parties are looking for, and you can structure this to best fit the both parties involved.
One of the things we really encourage you to do, I think, Dave, if we go to the next chart, here is a spreadsheet I built for my farm to kind of evaluate some different alternatives. And so this was a flex lease agreement, and the base rent was here, and this was the expected yield and the base price. So you can see this maybe a couple of years ago, where we're going to flex, and then we were going to flex on 30% above the base. So I calculate base revenue, and then in these charts, I show what happens to the tenant returns at various prices and various yields across the top. And shaded in red are ones where, I'm starting to do better than I would have under the base, just the base rent. And these are kind of returns less variable costs. And then you can see down here for the landowner too, it's kind of helpful for them to see, what prices of yields and price combinations do they start to get better returns than their base rent. So, here it's this kind of red area. Here's their returns where they start to do better if prices improve or the yields improve. And this can be very helpful in terms of, maybe we had a different view of the productivity of the land than the landowner did. So we can go in and say, well, here's the bonus, and here's what your returns look like if you're, thinking this is the productivity is maybe, true productivity is maybe 200 bushel an acre land as opposed to 185 bushel. And so I found that to be very helpful in terms of calculating just what those returns look like.
So this is a powerful tool to help sort of look on both sides of the table, right? How this agreement might play out between the tenant and the landowner. Another important thing, a second tool or a second measurement to look at is thinking about how these different rent agreements might play out under different scenarios. And so very similar to what Brent talked about earlier, you can turn around and say, okay, if I have a fixed cash agreement or a flex agreement or a share agreement, and I know my budget, okay, let's go through a base scenario in my budgets, and I take out my revenue minus my variable expenses minus that rent charge, and here I'm plotting the contribution margin, or how much money you have to cover those fixed expenses, the debt service, the family living, etc. So don't dwell too much on the numbers here, but think about how you can do this for your own operation. So here's the base scenario, right? So you're looking at this like, wow, the flex is, maybe going to be a little bit better return for me, and the share agreement might not get me as much contribution margin after all my expenses are paid. Okay, then we can consider a best case scenario. So 15% above yields, 15% better prices. How does that play out? Well, now the fixed agreement starts to look much more attractive. The share agreement still lags. And finally, you do a worst case scenario, 15% below budget yields, 15% below budget prices. And now you start to see where the share agreement starts to have some advantage. And that's a $50 per acre contribution margin difference. And this is a really helpful tool for you to, or a measurement or a process that you should be doing for your operation to help you think about the risks management element to some of these agreements. And not all of them perform the same way. And if you're in a part of the country where you can have multiple years of bad yields, if you're drought prone, you can see a situation where those share agreements might have a little bit of advantage. Finally, don't be like your neighbors. And this is a situation where I was surprised by this. What percentage of leases are covered by a written agreement? And this is on an acre basis. And so we can see that, best case scenario, 50 to 60% of the acres that are leased or rented have a written agreement. It's really important to think about that and really think about that as you're getting into an agreement with somebody. These rental agreements can help you. These written agreements can help you manage that. And finally, I'll cover these, and Brent, you can jump in with any other points you want to make before we get to Shannon. Calculate the scenarios, build some tools, think about it, how it plays out. Again, Brent showed you sort of the farmer side and the tenant side, but also thinking about how your farm's financial outcomes might be impacted by the various rental agreements in different scenarios. The second point is consider government payments. There have been some ad hoc payments the last few years that weren't plannable, right? Weren't predictable. So we need to think about how those government payments are included. The third point here is benchmark with caution. A lot of times we use benchmarks to help us as a starting point, but we've got to be careful. What benchmarks are we using? There's a difference between the coffee shop average and the actual average that maybe the USDA is publishing. So which one is the most appropriate? And finally, know what works for your operation. There's the starting point, which could be our benchmark, but then we also have to know what is your reality and what works best for your operation.
Yeah, David, and I think that you made all the important points. This government payment one is one that's really hard right now to kind of budget for and plan for, and it's creating a lot of uncertainties. It's something you want to think about. It's probably the biggest wild card right now in terms of renting farmland. So let's go ahead and switch to our expert.
Well, first off, thank you, Shannon, for joining us. You've helped us pull this together. You're going to share some of your expertise with the questions that Brent and I have thought of, and then again, you've agreed to stay in the overtime section for our Q&A, so all of our listeners can get their questions submitted. We got a lot this month, but we're going to get through as much as possible. So get your questions in, and we look forward to that as well. So Shannon, the first question I have for you is, if a producer called you and was looking for some advice for putting in a bid on a farm, what are the 2 or 3 main points that you want to make sure that you shared with them?
Sure, David, thank you. That is a question we receive often. There really are 2 major focal points that I would start with a producer that's calling, inquiring. The first one is, what does your projected profitability look like? Have you run the numbers? Do you have an idea of yields, and do you know what your costs are? What is the real likelihood of that profitability? It's important to run different scenarios too to understand what your projected profitability is. So the first topic of conversation with me always starts with cash flow. The lure of adding acres is one that we see often, but really it does start and stop with cash flow. The second main point I would say is, does it make sense for your operation? So how close in proximity is this ground to your current operation? Things like, would you have to add machinery and equipment? Do you have labor resources to add these acres? So really those 2 starting points is really where I get started in initial conversations. So again, added acres doesn't always equate to added profitability. So that's always, especially right now, one of the main things we talk about.
Yeah, it's really helpful, right? The idea of, if I add acres, I can spread my fixed cost and lower my cost per acre. It's a powerful idea, but we got to make sure it actually is backed up with reality.
Right, and one of the things you want to do is understand, what does my cash flow look like with the added ground, but also, does it add some cost? Are there costs associated? Will I have to add to my equipment? Will I have to pay labor? So there's a lot of ancillary things included in that decision. It's not just a, yes, of course I want to add acres. It has to be very calculated.
Let's switch hats a little bit, right? Let's think about the landowner or maybe a land investor, and they're calling to get some advice about renting out a farm. What are the 2 or 3 points you want to make sure that they think about?
Sure, and I'll start with 2 points again. This conversation with an investor triggers much of really some similar questions as it would for a producer. Again, we'd start with the money piece. So if you're buying land, what's your cost to buy that land? And what's your projected rent? And what is the resulting return on investment for you? And is that resulting ROI acceptable? We start with the money piece. I always like to start with the homework that they've done to calculate, is this a sound financial investment? The other piece of that is, what percentage of that payment might you have to subsidize with other sources of income? And are you comfortable with that subsidization? We have to think about how we would structure the loan and what the payment looks like and what happens to fixed costs and those considerations. The other part with investors is how knowledgeable they are with the area. Do you have tenants in mind? What's the reputation of those potential tenants? And what do you know about the land? Is it going to need improvements, for example? If you buy this ground at a set price per acre and think you have your ROI, and then you come in and, well, the producer now wants it tiled. What does that look like? And so there's really two parts to that. What does the financial piece look like for you? And how knowledgeable are you about that potential investment?
That's great. That's a really great starting point. So sometimes we build some assumptions up, right? But we got to step back and really recalibrate our thinking and make sure that we're in the right spot. Earlier, Brent and I mentioned the challenges of getting that bonus mechanism on those flex agreements, getting that right. What are some things that you've seen that work well, and what are some things that you've seen that don't work well in those type of agreements?
Sure, and I'll start with what I've experienced that maybe doesn't work as well. Brent touched on one key point, and that is over complex agreements. When there's a lot of complexity to an agreement, there is a lot of room for miscommunication or misunderstanding. So, extraordinary complexity to agreement doesn't always serve the intention it has. What also doesn't work well is if we haven't really discovered together a very fair base rent. So putting a lot of time and effort into the discovery of the components of a base rent is really important. When that does not happen, that can really lead to some issues as you negotiate future contracts. What does work well, really good communication, I would say, sitting down in a room and discovering the components that you're using to determine your cash rent or your flex agreement, knowing what the other's expectations are and laying those out, very transparent communication between the two parties. And really, maybe you utilize a third party sometimes to help you discover some of those things. And using sound data, using your crop insurance for yield information, deciding if we use a 3-year average at the elevator for price. Just, I would stress very good communication and contracts that are easy to understand by everyone.
One of the starting points is probably going back in history. Can you see what the rents would have been the year before, the year before that? And that could be a good starting point to test out your trigger mechanisms. So I have 2 more questions for you before we get to the Q&A. In this environment, Brent mentioned this earlier, we've had to work negotiations or work cash rental agreements or rental rates back because of low commodity prices. And one of the hard things for a producer to do is sometimes to decide to walk away. They can't get that lined up with where they need it to be, that rent agreement lined up where their costs are. How do you help producers think about that?
It really starts and stops with cash flow. And walking away from a piece of ground is always difficult. That's an emotional piece of this. I would ask that a producer step back from the emotional side of it a little bit and really use data to drive their decision. If that farm ground is not cash flowing, there's lost opportunity there. So with everything you do, there's an opportunity cost, right? So if you're spending resources, time, capital to farm that ground that isn't cash flowing, and you're trying to look at it in a bigger sense, drilling down to that particular farm and saying, okay, so, but what is my lost opportunity here? Can I allocate those resources I'm using to this, to something that is going to be profitable for me? I like to equate it to a store owner. If you're a store owner and you've got a product sitting on the shelves and it's taking up shelf space, but it's not reaping any reward for you financially, you're going to replace that product with something that does, right? So there's a couple parts to that. Using logic versus emotion, and really understanding what I can replace that with, and being able to walk away and being comfortable with that. If at the end of the day you've run all the numbers and tried different things and it just isn't working for you on paper.
Yeah, it's a hard decision, isn't it? And I think one of the things that makes it really hard, as you point out, is there's a lot of opportunity costs involved, because usually we can make them cash flow on a cash flow basis, but is it really covering opportunity costs? And that's where the real challenge comes in, and what's the alternative, right? And so I think you hit the nail on the head with that.
Exactly. And I think it's a neglected part of decision making is we're always trying to figure out what we're gaining, right? But sometimes in that there's a loss that we're not considering too. What am I losing by not potentially replacing that with a more profitable venture, whatever that might be?
All right, Shannon, we have a lot of questions in the Q&A hopper this week, but the first one I want to make sure we get to is the one I always ask, is if there was one piece of advice that you would share with producers here in August 2020 that you could put on a billboard for thousands to see, what would that advice be today?
Well, I hope it's a big billboard because I'm not. What I would really say is you need to run your farm like a business. That includes knowing your numbers. It is a family operation in many cases, and so the tendency is for producers to want to go do what they love to do, right? They love to produce, but we really have to run it like a business, and we have to make business decisions based on calculated information.
No, that's great. That's really great because, and this fits in well with the cash rental, right? Sometimes we're negotiating with family members, and that's really, really challenging. And sometimes we're negotiating with people we've had relationships with for a long time. So when we run it like a business and we can bring data and business practices to the conversation, it can really help take some of that emotion
Exactly.
out.
Yep. Factual evidence of how you arrive at what you do. That's a great point. Negotiation can be a little bit uncomfortable for people, and especially with family and folks that you've known for a long time, but you really have to approach it as a business venture.
I think we can just start right in on the questions, and we'll start with, I've got a few sitting here, and then we've got a whole bunch more. First one, is it typical for cash rent to be 100% paid by March of the crop year? I'll give an answer and then turn it over to the other panelists. And I would say, I think you saw the data that we presented on all the different types of leases, and I'm not sure anything is typical. That happens in some cases. It seemed to be a trend for a while that we're moving toward 100% paid up cash rent right off the bat, but I think it's a point of negotiation between the tenant and the land owner, and so I think it's a negotiation point. In some places more common, that might be something you're willing to concede or not. And so I think I wouldn't say it's typical, other than it does happen for sure.
I would agree with that. In my area, I see a lot of fall and spring payment schedules, but that honestly is very, it's very flexible more times than not. And a lot of contracts that I run into are annual contracts, and so building that payment into fall and spring makes sense in those situations, but it does vary by producer and vary by situation.
Next question, as a landowner, I've always used crop share leases, but starting to wonder if the operator need to keep separate records for my land, which may be only a small part of his operation, etc., are worth it. And I think that's one of the drawbacks to the share rent. The share rent agreement, in my opinion, is a great tool to share risk. It really is a fabulous way to do that. The challenge with it is, as you pointed out, there's a lot of record keeping, and there's a lot of trust that has to be involved in terms of measuring those outputs and the inputs that are put on. So there's certainly some downsides, and I think that's a question you might want to have a discussion with the tenant over as to whether that makes sense in this environment for you both. But I think it has a lot of benefits. The share rent has a lot of benefits, but it has some downsides, and that's one of them.
Yeah, I think you hit on it too. The share rent can be very positive for both parties, but it does take away some of the autonomy that one party may want a little more or less of. So it does require a lot of accountability and communication on both sides.
So we have another question that basically says, we have a 2-year cash lease agreement. Obviously, weren't expecting, things to unfold the way they've unfolded this year. Can we approach the landowner about reducing rent on the second year, or are we locked in? And I think that's a question, in some cases you may be locked in other cases you can have that discussion, and I think it's just a communication issue. That's one of the downsides to the longer term agreements, as Shan pointed out. They are longer term, and they carry some additional risk. From that perspective, it could be positive too. I mean, things could have been better this year than you had expected, and I think we have to ask ourselves, if it had turned out the other way, and the landowner came to us and wanted more, how would we approach that? How would we feel with that? And maybe the answer is, well, yeah, we renegotiate it. So I think that's the way I would approach it in my mind, is in thinking about it.
I think the supply and demand of crop acres that were available sometimes lured producers into thinking, I'm going to try and lock into a longer contract so that I'm not at risk of losing that ground. There is a definite downside, though, to longer contracts, and we've just talked about it. It really does take away that ability to renegotiate to a degree sometimes, and to move along with the market. So when you're deciding on a long versus a short contract, take into all of that into consideration and make a decision based on, maybe my long-term goal is here to own this ground, and a longer-term contract makes sense. I have a lot of trust with that landlord. But if some of those considerations don't come into play, you might just want to consider a shorter-term contract so that you can move a little bit more with the markets and with production. So.
Another question, probably a good one for Shannon, is for an investor, what % of a down payment do you typically see to be necessary to support annual payments using only the farm income? So in other words, if we buy this farm, how much do we have to put down so that the rental payments make the payments? And it's a good question, not one I have on the top of my head, but the way to calculate is get your financial calculator out and start seeing how much, what the present value of those payments are. And remember, don't forget to take out your property taxes and other ownership costs.
Yeah, there are tools available to start running through those scenarios. That one's a little difficult for me to answer given the wide geographic area we have on the call today. What you have to pay per acre and what the rent that you may receive on that can vary so much by region that there's no magic number that I have in my mind. I want to default to right away saying typically what we require for a down payment, but again, there's a lot of variance in that. I would encourage you to talk to your team around you and start running some of those numbers together.
Yeah, I think with sitting down with somebody, you could come up with that number pretty quickly.
Exactly.
And it's going to depend on, obviously the rent, the property taxes in different areas,
right.
and all that stuff.
Right. Purchase price, term of the loan, which really determines your payments, right? Interest rate. So there's a lot of variables that come into play. That's a little bit tough to answer with one golden number, but certainly use your lending team or your team of experts around you to help you run some of those numbers.
The question has a lot of variability and based on all the factors you mentioned, but it also is a goal of the individual that if it comes up in the rental agreements, when we're talking with landowners, all of a sudden we can start to structure a rental agreement that starts to reflect that desire and that goal. So that's a really important goal to share as we think about the rental agreement. So not only calculating the number, but sharing that desire as you go find a farm to help you farm that.
Our next one talks a little bit about negotiating with family, and a lot of pride of ownership in farmland, and maybe not a real good understanding of the costs of operating. Particularly, I think it's pretty easy to line up and demonstrate the variable costs, the seed, the fertilizer, that kind of stuff. The one that I think is a little bit harder sometimes to communicate is the equipment costs. And so any ideas on how to broach that subject or how to handle that negotiation?
And there's always an added layer of complexity maybe when you're talking with family members. But to that, I would say do your research before that conversation happens. Understand what your machinery and equipment costs are, what they need to be. What is the benchmark per acre machinery and equipment cost? And are you above or below that? Know your variable costs when you come into that discussion. And be prepared to have there might be some level of discomfort, and that's okay. Everything doesn't have to be decided in that same first meeting. Sometimes presenting numbers to your family then will spark a subsequent meeting later on after there's an opportunity to kind of digest all that.
Another question about the 50-50 share rent and saying, well, is it really equal? Because the landowner's costs, such as real estate taxes and well expenses and well repair, are known, but the operator's expenses are not. I would say I don't necessarily completely agree that all the landowner's expenses are known. Those well repairs and irrigation system expenses can be pretty lumpy and pretty uncertain as to when they're going to happen. But the point, I think, is to say, if you don't feel that's fair in your situation, let's take a look and see if we can come up with a share that actually does make sense, and what that would be. And so that's where I think you really have to crunch the numbers to come up with it. But when David put that question in about what's the most common share around, I was kind of like, well, why are you doing this? And the reason he put that in there is to just kind of show me even that man, there's a lot of variability in rental agreements, and there is no magical written rule that the share rent has to be a 50-50 share rent.
I think it's important to keep in mind there are mathematically an infinite number of ways that you could structure a rental agreement. And then when you add the next dimension of all the different preferences that individuals have, you get to a really big number of possibilities. And we have some local norms or share agreements that are traditional. But the goal here is to highlight those, but also to encourage you to step away from that. Like Brent said, if the 50-50 isn't going to work, then how can you find a rental agreement that does? And Brent mentioned this. One really important piece of advice for negotiating is there's a lot more to negotiate than on just the price. And so maybe a producer has a skid steer, or you have some expertise in servicing the irrigation system, or you can help make some improvements to the land that you might not be paying a very high per acre expense, but you're trading it off for something else. And so we really need to really think about how you can create an agreement that works for both parties, and think about each negotiation as sort of, we have some starting points, but how do we get to something that works for everyone involved?
Right. I'm trying to move people off of just the price number is usually a good strategy of trying to kind of provide some information about some of the other benefits that you can provide or require.
So Brent, one story about negotiating more than price. My dad had a neighbor, and I was growing up, and he was really proud of his ground. He wanted to get paid the highest amount of acres for the ground. And my dad said, the highest I'll ever pay you is $55 an acre. And it might have been 60. I don't quite remember. But this was before the ethanol China story. And this was eastern Kansas, right? So it's not great ground. And that was a high price. Well, rather than negotiating the price every year, because the guy knew my dad wasn't going to budge on the price, he would adjust the number of acres he had to rent. So first it was 97, then it was 100, then 101. And by the time that the guy passed away, it was 103 acres. And in the middle of this, of course, is when GPS came in and yield monitors. And my dad knew exactly how many acres were being harvested. And you just have to realize sometimes this is just a part of the negotiation, and is part of the back and forth. And so there's a lot of areas and a lot of levers to move, so just keep that in mind.
The last thing I would really quickly point out is use the team around you, and there are really a plethora of resources available. A quick Google search on crop rental agreements is going to bring up a lot of information for you to look through, read through. The other thing is a lot of the state extensions have really great information on different rent structures, flex lease structures. So find the resources and use your team around you to help you negotiate, to help you understand exactly what would work for you and the other party.
What about cash rent varying between crops, e.g. corn and beans?
Again, that's a price discovery and a yield discovery on those crops. Typically, we see farmers, rotate those crops every year, and so the cash rent is basically a straight cash rent agreement is set regardless of the crop. But if you start moving to a flex agreement, then you may want to consider, or you will have to consider all the other components, price and yield in that flex. But in terms of straight cash rent, since there usually is a rotation on those, it's basically a straight cash rent per acre. Where we do see some fluctuation in that is if part of the ground is pasture and isn't crop, then you may have to take into, or you will have to take into consideration the non-tillable and factor that into your cash rent figures.
What about cash rents and flex rents being so common? How are people handling that with government payments, and especially ad hoc government payments?
I think the ad hoc payments are really challenging, especially if you're in a share or maybe a flex agreement. And so I think part of it is it's important to have those conversations early and know the spirit of the agreement and then write some details down. And so when we knew those flex agreements were coming up, or those direct payments were coming up, start to have those conversations. And so there's sort of what the contract says, and then when something deviates from that, how do you negotiate that? And having conversations early is really key. And kind of as Brent said, think about it, it's a two-way street, right? These payments might benefit one party today, but what would you like to have happened if it goes the other way?
Right, and I don't have a lot to add to that other than, those government payments sometimes are a year in arrears too, right? So, taking a look at the history of the ground is important, I think, when you're talking government payments too. Wet ground tends to stay wet, and farmability comes in, and you can start to have some level of predictability on some of those payments as well, and maybe build some of the history into those conversations.
Yeah. What about? I think that you kind of hit it right on. What about some different metrics to evaluate rental rates? So we all obviously know the dollars per acre, but what about using CSR points or rent per bushel, expected bushel, that kind of stuff? You see a lot of that, or some good metrics out there?
I don't actually see a lot of that in my area, but certainly there are areas where CSR comes into play, and we start to align a specific cash rent per CSR. So we're taking into account productivity on the ground, right? The question that comes into play is, do I take the average CER over all, or CSR over all the acres? So sometimes there's some questions that arise, and you have to really be able to negotiate even further into a CSR or a bushel per acre, because there's a lot of factors that play into those too. And just the sheer, how do we arrive at a CSR? What,
Right.
that can be, there's a little ambiguity there too on how my farm has this particular CSR assigned to it, and is that accurate?
Right. And, those are, there's a lot of issues with all of those. And I think at the end of the day, the productivity of the land is what matters. And CSR is one proxy for that. It's an estimate of the quality, and it may not be perfect. But at the end of the day, if you're renting the land, you have to have an idea of what you think its capacity to produce is, and pay a rent that's according to that, as opposed to, we wouldn't want to rent all of our ground for the same dollar per acre. Some of it's just a lot more productive than others, and so we have to get at an element of that productivity. And that example I kind of showed with the spreadsheet was an example of that. I had kind of a base level of productivity that we could both agree on was probably achievable, and then what would happen if it, if we do better than that.
So that'll do it for another episode of Two Economists and a Lender. And thank you, David, Brent, and Shannon. Excellent topic, excellent conversation today. For those of you in the audience, thank you for joining us. We look forward to seeing you again online next month.